There is always a hard limit on any housing market, and that is the maximum amount of money a homebuyer can borrow for a mortgage. Now, the lower the interest rate, the higher the house price you can carry for the same monthly payment. As interest rates embark on a broad downward trend, resulting in house prices rising faster than incomes. The central banks, faced with signs of a global economic slowdown, are once again using low interest rates and buying debt to juice up the global financial system. The U.S. Federal Reserve already cut its overnight lending rate. This is the first time since the financial crisis of 2008 that the Fed has cut rates. In this competitive mortgage market, if a bank can make money offering a negative interest rate to borrowers, it will. And voila, here's your model for juicing the economy right into the bizarro world. While it may seem illogical for a bank to pay you to borrow money, the central banks may see themselves as having no other alternative. It's either that or they will have to let the debt-laden economy collapse without intervention. And for mortgage lenders, a profit margin is a profit margin. Whichever way, you make it. So there you have it. Expect a future in which the banks will make money by paying you to take a mortgage, and where you can make your debt easier to handle by taking on more debt. All this while the central banks are constantly printing more and more money. This cheap money flooding into the housing market means we are nearing the end of the road for the current housing boom. It is a cheap money loan to fuel this housing bubble, which is really starting to verge on a hyper bubble, as we see in the stock market today. Where low rates really bite isn't in current returns, but in the future gains investors can reasonably expect. Interest rates set a kind of baseline for the return on all assets. As they fall, bond values rise, and stocks often do, too. But once rates have settled at or near rock bottom, there's less room for that kind of price appreciation. All this has sent investors looking under every available rock for more return, even if it means taking more risk. The fear is this could lead to the formation of bubbles and eventually destabilize the financial system. Institutional investors are out there in the great truffle hunt for yield. This is particularly true of large institutions, like banks and insurance companies and pension funds. These firms are searching for yield and potentially taking on unintended risks because that is what they need to do. Mortgage balances climbed $57 billion in the first quarter of 2018, and mortgage debt is up to $312 billion from the first quarter of 2017, according to the latest data from the quarterly report on household debt and credit from the Federal Reserve Bank of New York. Housing debt now totals $8.94 trillion, close to, but still shy of, the $9.99 trillion peaks we saw in the third quarter of 2008. The Fed's extraordinary support of bond and housing markets will cause the market to crash as interest rates rise, leaving banks, mortgage originators, and lenders stuck with homes and low-yielding loans as the economy slows down, exacerbating the decline and pushing the economy into a deeper crisis. The bubble is coming out at a crucial time in American history. As it has been unusual for economic expansions to last more than a few years after the economy reaches full employment, which it now has under Trump, and the country should remain on the lookout for early signs of imbalances whose reversal eventually could trigger the next recession. With the recent events of 2007 to 2009 still lingering on investors' minds and nominal housing prices now exceeding their peaks from 2006, the housing market is an obvious place to look for signs of overheating. The housing market is now firing on all cylinders. This is irrational exuberance, as the market is fully subsidized by the Fed. The US government is guaranteeing all mortgages, and then buying them up. It's an artificial market, but the Fed, rather than Lehman Brothers, owns it. We are building more homes than we can afford, as hedge funds and speculators gobble up hundreds of thousands of properties being cranked out by the homebuilders. The foreclosure process is stalled in several judicial states while banks are still sitting on massive inventories of housing. Major banks and mortgage originators haven't gotten out of the mess they caused in the financial crisis. Bank of America, Wells Fargo, J.P. Morgan Chase, and Citigroup are still in the process of settling a nearly $20 billion tab with homeowners across 49 states. The day of reckoning will come when the Fed starts to tighten. It is amazing the Fed can admit he has no exit strategy. The Fed will just monetize some of its treasury and mortgage holdings, but will have to sell a lot of both to normalize its monetary stance. The Fed has made it clear they will telegraph the move to the market, but telling others they will sell is the worst thing they can do, as everyone will try to front-run the Fed. Recall that in the Great Recession, the stimulus of low rates was countered by a tightening of lending standards as lenders feared rising default risk. Ultimately, the collapsing system was bailed out as a consequence. Even the rules regarding insolvency had to be changed since many financial organizations were technically insolvent, too many non-performing loans, bad derivative bets, overleveraging, etc. This time around, rates will move downward but will have a little stimulative effect since low rates cannot force borrowing if the borrower doesn't want to borrow. The public is already overleveraged with mortgage, auto, school, and credit card debt. Thus, the negative wealth effect of housing price declines will be magnified. The trade war is the proverbial straw that broke the camel's back. This is the setup for a self-reinforcing downward spiral. When chickens come home to roost, we'll probably get zero interest rate policy. We are almost there now, possibly even negative interest rate policy, government asset purchases, and even worse exploding deficit, and a move to use infrastructure spending and other tools to get things moving again. It will take years to get back to relative normalcy. House prices cannot continue to go up. The following generations aren't making money to feed this monster. The following generations don't want to be saddled with a house that won't make money and will cost money to keep, plus the taxes. Interest rate suppression is already stealing your nest egg. Add some modest inflation, read hyperinflation, and those equity investments of yours, despite their 800% appreciation, won't buy more than a few months of toilet paper. Real assets are the only assets that matter. If you can't touch it, it isn't a real asset. With 25 million excess, empty and defaulted houses out there and another 35 million just beginning to empty as boomers die off, it's going to take a bunch more than investors to prevent housing prices from falling. High housing costs, both for rent and for sale, have extracted all the discretionary income from budgets and are leading to the death of entire industries, retail, which are dependent upon said discretionary income. The Fed and complicit politicians are to blame. A home is not an investment as the real estate industry insists. It's a money pit. Houses are very overpriced. Prices are held up with easy mortgages and low interest rates. As soon as they start raising interest rates, then prices will tumble. Also, there are tons of properties held off the market, a hidden inventory, by the foreclosure banks. Will the Fed now start buying houses in order to stabilize the market? A great deal of this housing recovery that has driven the average home price up 30% since 2012 has been the result of Wall Street hedge funds buying in bulk foreclosed houses in order to turn them into rentals. Like many people, I find it totally objectionable these deals were bundled and offered in such a way that allowed big business to crowd the average American out of the housing market. In parts of the country, cash fleeing China and other troubled countries has flowed into the market, pumping up prices. These types of situations create a questionable base for higher home prices when we consider the low end of the market is driven by Fannie, Freddie, and the Federal Housing Administration, all ensuring 3.5% down payments from borrowers that lack substantial collateral. History has shown that such special financing simply encourages people to rush out and buy homes they cannot afford. It is important to remember that low interest rates do not necessarily bring about quality growth or prosperity. Decades of slow growth in Japan has proven this. One of the sad accomplishments of current Fed policy is that low interest rates often do not create all that much new demand but simply moves what does exist forward. To make the situation worse, the Federal Housing Administration is busy issuing and guaranteeing risky mortgages written by thinly capitalized non-banks. In 2012, the large Wall Street banks represented over 65% of Federal Housing Administration-backed loans. Today that number has cratered. Even they have realized loaning money to people that won't pay it back is a recipe for disaster. America is preparing for a replay of the 2008 housing crisis. Our politically motivated government has insured subprime mortgages with down payments of as little as 3.5% while using weak underwriting standards. We are even seeing restrictions raised on borrowers with past foreclosures in a housing market that may drop 20% when this Fed Wall Street bubble pops. Years ago, Lee Iacocca, who brought Chrysler back from the brink and made the company viable, said something to the effect of when you special out all your cars on Monday you have no sales for the rest of the week. In the current situation, low interest rates are only one of the factors distorting and skewing America's housing markets. A strong appetite among foreign investors for office buildings, apartments, malls, and other real estate has, in part, fueled the long-running bull market in U.S. commercial property. Now, amid a maturing property market cycle and rising uncertainties in geopolitics and the global economy, foreign investors have sold more U.S. commercial real estate than they bought in a quarter for the first time since 2013. These are no longer homes. These are bank accounts of the global rich hiding their money, either ill-gotten gains or evading taxes. They will keep dumping the failing loans to big investors with plenty of printed money to scoop them up. They may sell a few of them to the common folks to save face. With the remaining inventory, they will be gracious enough to rent the properties at the top dollar. This has been skewing the foreclosure numbers for a while and limiting supply to keep prices up. Think about it. 30-year mortgage rates are in the 3.5% ballpark, and home sales are declining in many parts of the country. Who's to say that there won't be a much more rapid, time-wise, symmetrical retracement on the way down? Just because there was a 6-year time frame on the way up doesn't necessarily mean there will be a resultant 6-year symmetrical retracement to the downside. The same could be true for equities, which ascended from 2009 through today, with occasional pullbacks, retracements. When this baby, equities, housing, takes a dump, the time frame will look nothing like the elevator ride up. The cable holding the elevator will be non-existent. So, if you're anticipating the correction moving at the pace of a leisurely walk down a flight of stairs, you're in for a rude awakening. 1992 Agenda 21 was signed, which essentially declares the U.S. middle-class lifestyle unsustainable. Get rid of single-family homes. 1997 Bill Clinton repealed the Glass-Steagall Act. In 1995 pressured banks to lend to low-income neighborhoods. In 1997 he signs the Taxpayer Relief Act, which rewrites real estate capital gains tax law and turns to house into a speculative endeavor. Massive amounts of debt are taken on and set the stage for bubbles. In this time student loan also takes off, but weirdly, it cannot be discharged through bankruptcy. And now we Americans talking about how, somehow, houses have become too expensive, and younger generations saddled with student debt have no hope of ever owning one. This was orchestrated, and the plan is no more single-family homes. It's being designed to collapse. No more property rights. This whole economic model of fiat currencies, fractional reserve banking, and infinite economic growth will end in a disaster. It could be in 3 months, 6 months, a year or 3. 2008 was just a warm-up. They kicked the can down the road by bailing out banks that were too big to fail and pushing catastrophic monetary policies. You see, this economic model of growth is like an opioid addict. He's fine as long as you keep the fixes coming, another injection to keep the good times going. Heroin? Quantitative easing? It's all the same. How many trillions are they going to have to print this time when heavyweights like Deutsche Bank collapse? Who ends up paying for it? You do.